Let me give you a brief introduction to our speaker today. His name is Stephen Kwong, and Stephen is the Senior Vice President of Futures Broking in M Investment Bank Berhad. He serves in the leadership role in the company and is responsible for the business development, operations, sales, and futures broking division. And he is also a veteran in the industry with over 25 years of experience in Malaysia, listed derivative and security industry. So definitely he's the right person who will be sharing you his insights as well as knowledge about how to becoming a professional trader someday, right? So without further ado, let me pass this to Stephen so that he can share with you all of his insights as well as his knowledge regarding the field. Right, Stephen, back to you.
Thanks, DY.
Hey.
I hope it's clear. Everybody can hear me. Yes?
Yes, we can hear you.
Good. Okay, let's start. First of all, hope everybody's feeling safe, stay safe, staying at home and feeling healthy. I'll try to explain today's topic as clear and as simple as possible. Today, we're going to cover trading for a living. And we're mainly going to cover three main categories of professional traders that I think each and every one of you should know about. Okay. First of all, this is very standard disclaimer. And then we've gone through my credentials. So let's go straight through it. Okay, shall we? Now, there's going to be three topics that I'm going to cover. The first one is actually categories for professional traders. After this topic, you will or should have a better idea on the type of trader that you want to be or that suits you. Futures at the end is a zero-sum game. So each of your trades will be against one of these three categories. That means basically when you buy, there will be a sell, and the sell will be one of the three categories that I'm going to explain here. So it's good for you to know as well when you trade against somebody or some position, opposite position, you would want to have an idea, why am I taking this position and why is the person taking the position opposite me? You will need to have an idea what the person could be doing at the other side. So just to have a good idea if whether your decision is correct or not. Towards the end of the session, I will show also a performance slide of some of investment banks traders overall results in the recent last 12 months. So they will also give you a rough idea, you know, which category you'll be like to be pursuing with. Okay. The second topic will be more on prerequisites to becoming a full-time trader. This topic covers the tools, the characteristics, and the financial needs required to be a full-time trader. So if you want to follow the path of becoming a full-time trader, this will be the topic that you will need to have a good grasp on, as in like what is needed to be a good trader. Okay, the third topic is the opportunities that will come your way in trading full-time professionally. This slide will cover the step-by-step phase that you should take as you progress to turn to a full-time trader. Okay. Now, without further ado, let's go to the first topic. Three categories of professional traders. Now, for the purpose of this seminar, the reference that I'll be making will mainly be on Bursa's two main products that they have, which is the FCPO, the Futures Crude Palm Oil, and FKLI, which is the Kuala Lumpur Composite Index Futures. Okay, so all reference will be made to that. There are going to be three main categories. They are a speculator, and you can be an arbitrager or a hedger, or even a spread trader. Okay, now I'll go each and every one of them as simply as I can. Right, before I start, there is something that I would have to point out. I would expect that most of the participants here will be well versed or knowledgeable on the basic futures and its contract specifications. So I won't go into too much about the contract specs. I would imagine that most of you will have a rough idea how a futures contract works. Okay. Now, generally, the first category is speculator. All right. They have bigger risk appetite compared to the other two, which is the arbitrages or spread traders. Okay. They take positional trades only. Because they have a bigger risk appetite, they would expect a higher return on investment. Okay. They have they have positional and directional view of the market only. That means one way. Either it goes up, they will buy, or if it comes down, they will sell. Most of these speculators are predominantly individuals or small funds, as we call it. There are mainly two types of speculators. One is a short-term speculator, which normally we call them scalpers. And then there's the medium-term speculators. Okay. Scalpers mainly trade within seconds or minutes. They will go in and out. Whereas medium-term speculators, sometimes few minutes, sometimes a few hours, but definitely within intraday. Okay. Now, short-term speculator. Again, if the market is volatile, they go in and out within seconds or minutes at the most. They trade mostly on sentimental or sometimes momentum trading. Okay. Now, when I say about momentum trading, they have a certain target. So most of these scalpers, as we call it, right? They look at psychological levels that they will aim that the prices will be moving towards or about to go towards too. All right. They will be also looking at triggering margin calls as well that will create a certain momentum or wave, as we call it, to take on a position. Okay. Now, when I say earlier on in the slides, they have very high risk appetite, but that is the risk appetite. Okay, when I mentioned here in this point, they have a low risk tolerance level. It means that once they feel that the momentum is not there, they just exit and that's it. They just end the game. They don't care whether it is something that it's against them. They just have this feel that once the momentum is not there, they will just get out, or they might even reverse the trend and go opposite position as well. I mentioned earlier on again, they look for psychological or historical pivotal points. That means all-time high, they will look to breach it and even go beyond that, or all-time lows. They trade mainly on gaps as well. All right, this is the effect of margin squeeze that they like. If you look at the FCPO market that I mentioned just now, the crude palm oil market, okay, every day, especially in the morning, you will see that on opening, there will be gaps, at least 20, sometimes 60, 70 points from the previous day's close. This will create what we call a margin squeeze, and that will have a domino effect, that will push the market to a big wave on the very start. Okay, I will try to explain a little bit about that at the later slides. They trade basically on very low or small tick points movements. That means they just look at small point movement, they just take profit already, and they just do a lot of these kind of trades, many trades within a day, and that's how they make their money. All right. Again, there might be question, how small are these tick point movements? Well, that depends on the volatility of the product. If you're looking at FKLI, the volatility is not high. Sometimes 3, 4, 5 points, they start taking profits already or cut loss. And then if you're talking about FCPO, sometimes 10, 20 points before they take profit, because the volatility, it depends really on the volatility. Again, I'll explain most of this as I give some examples on the slide below. Okay, high volume and turnover. Again, when these scalpers, basically, like the name says, they scalp. When there is a high movement, they just go in, out, in, out, in, out on a daily basis and just keep on making the profits on a small range band. Okay, their cost is also very, very low. Now, why is their cost low? Because basically they are charged brokerage when they trade. So a broker like me would say that if you trade a lot, it's a demand and supply. If you trade a lot, I will give you a lower cost because again, if you trade a lot, then you can justify demanding for a lower cost. So the more higher volume that you provide a broker or turnover, the cost should be lower on the brokerage side. Okay. Now, what are the important assets that I think a scalper should have? Firstly, experience obviously is very important. Now, the next part is quite unique. When you talk about scalpers, it's actually a feel for the market. You know, an experienced scalper, you know, even after a couple of weeks, after a couple of months, they have a good feel of the market, as in like, you know, where do you think some cut loss points are? Where do you think some of the price perch is going to be, and where the prices are going to be attracted towards to? Those are the things that scalpers sometimes, after for a while, they have a good feel of the market. And the last bit is speed, execution of speed. The thing is that, you know, if you're a old guy like me, you look at the keyboard and you start, you know, buy, do, and by the time you press the execution, you want to execute it already, the price already gone. So this is really for a fast pace execution mode. Okay, you have to be really, really good in executing your orders. Discipline obviously is very important. You have to have a standard risk management ratio. I will explain a little bit about the risk management ratio in my examples before. Okay, going back again on the speed of execution, as far as scalpers is concerned, most of them keep the orders simple. That means they don't start putting in like, you know, 5, 10 orders at a go, park here, park there, you know, put at a certain historical or technical analysis points. That will very complicate things, because when things starts to go wrong or volatility is high, they will not be able to pull the orders out in time. So definitely simplicity is the way to go, right? They don't like to put too many orders in. Again, another part about execution speed, as you know, everybody is doing things online right now. So one of the important assets when you are executing fast, make sure you have a very good connectivity. You don't want those very, very slow modems, and then, you know, you're getting hang down there. That's not going to help you at all. Okay. What kind of funds are we looking at? If you ask me, from my experience, right, if you want to be a speculator, you will need roughly, and this is just a trade Bursa Malaysia products, right? You will need at least about 30 to 50,000 to start off, and this is if you want to become full time. Okay, anything less than that would be difficult, and I really won't advise it. Okay. Again, that will also depend on the contracts that you're trading, but around about 30 to 50,000 should be right. Okay. I want to reiterate again, at the end of this session, there will be a slide on the performance of the speculators that's within M Investment Bank. Then you can see what kind of expectations can those traders be looking at. Now, let's look at some examples. If those of you who knows crude palm oil or have been observing it, you will know that, you know, CPO in Bursa Malaysia easily swings 5 to 10 points within seconds, or even you know, within minutes and even seconds at times, right? So it's very volatile. Also, you can observe that between the buy and sell, the number of contracts there easily can absorb 5 to 10 contracts. So if you decide to do take a position of 5 to 10 contracts, you wouldn't lose buying the price up or selling the price down too much, and you'll be able to execute your orders quite conveniently. Some background here, initial margin requirement for FCPO over the last years in Bursa Malaysia is around 6,000 ringgit per contract. So something for you to try to understand here. If you know one tick or 1 point of the FCPO contract is 25 ringgit. So for a 6,000 ringgit deposit, mainly means that 240 points away from your point of entry would then means that your account will be going down to zero already. Zero. That means anything beyond 240 points from your point of entry, you start to become negative in your account already. Okay. So you can imagine if there is a 60 to 120 points movement against you, you are losing already 25 to 50 points of the deposit of the 6,000 that you put in. This level you've got to be aware of. Again, I reiterate, some of you who knows about futures trading or the contract specs, there is such a term called maintenance margin that is implemented by each broker, any broker that you join. For example, in my firm, if you go in and if you have something like 70% left of your initial margin, we will be again calling you to top up on your position already. Some might let you go down to 50% or so forth, but there is a maintenance margin which you have to make sure that at every time your open positions or your contracts is well above so that it doesn't fall below that. Okay. I will go into some more examples in the next slide. Meantime, there's a few more pointers that I want to bring up to you. Okay. Again, as I mentioned, brokerage costs will depend on each broker. The higher the higher number of trades that you put in means that you can actually ask for your brokerage to be lower and lower. Okay. Something about scratch here. There is a term. This is just terminology for some of you to know, right? Scratch means that within the same product, the same contract month, and within the same day, if you buy and sell it at the same price, there will be zero cost to you. This is something that Bursa offers if you are a designated local member of Bursa, right? This is just for your information. I will mention this again in the next few slides, just for your information. Okay. Basically, a scalper takes sometimes 20, sometimes even 30 positions within a day. We call it punts. You know, they just have a view. They just feel that there's a momentum. They go in. After a few points, they get out. And they will keep doing this, sometimes 20 to 30 points within a day. Why? Because they have a lower price band that they trade on. Okay, I'll give you examples again on the next slide. Just so mainly that you know, because their price band is low, they can make more trades within a day because the volatility allows them to do so. You might get a little bit lost here, but I hope this will all come together when I can give you a little bit more examples at a later stage. Okay. Risk reward ratio. This is something that most traders must have, and I encourage you to have a plan, right? Basically, most of the traders that I know, they have a 3-10 risk reward ratio. What does it mean here? It means that if you are willing to take a 3 points loss, you should have a target that you want to take profit when it reaches a 10-point gap from your execution point. Okay, so it's 3 to 10. Let's put some numbers here so that you can have a better perspective. All right. As I said just now, you can, for FCPO, you can easily put in 5 contracts, and then you should be able to fill it easily because that Bursa Malaysia products is actually quite liquid. Okay, so if you were to put a trade and it involves 5 contracts, okay, what does it mean here? If it's a 3-point loss against you, that means if you buy and the market comes down against you 3 points, you cut loss. And if you sell, you want the market to come down, but instead it goes up 3 points, it's against you, you cut loss. So in terms of monetary value, the loss will incur is actually 5 contracts times 3 points, and it's 25 ringgit per point. So your loss will be 375. But if you have a 3 to 10 point ratio, your profit, on the other hand, is actually 5 times 10 points times 25 metric ton is 1,250. So this is what I mean when you have a 3 to 10 point ratio. Okay, I'll put that in percentage perspective. That means you have a 25% success rate to break even. If you make 1 profit out of 4, then that 1 profit alone will break you even again. So if you have more than 1 out of 4, 2 out of 4, 3 out of 4, then you're really in the money already. Okay, these are some of the mathematics that will give you a rough idea, what to expect when you're trading as a scalper. Okay, initial margin requirement, like I say again, over the last couple of years for trading FCPO, you would have the initial margin requirement from Bursa is about 6,000 ringgit. So if you do 5 contracts, you will have to put up 30,000 initial margin, okay, to the broker. Now, what does that mean? When every time you trade, and it's actually a profit, if you have this 3 to 10 ratio, each profitable trade will give you a return on investment of 4%. How do you get that? It's actually 1,250. That's your profit divided by the 30,000 they actually put up. Okay. Now that is much higher than the current annual FD rates on an annualized basis as well. But there is risk as well. Because of volatility in futures, you can make 4% and you can easily lose 4%. Okay, so beware of that. Okay, now let's go on a little bit about medium-term speculators, right? The time span for a medium-term speculator can be days or at the most 2 weeks. Okay, they are mostly chartists, right? And chartists, I mean here technical analysts. All right, there are many technical analysis, but I really stress that each and every one of you must do your research on the type that most suit the product. Not all technical analysis will suit one particular product, so you have to do a bit of trial and error and test and see which one you're familiar with, and try to come up with a sort of like table, which one works best. And you must do this quite frequently, every couple of months, just to make sure that the TA, the technical analysis that you're using, still can work on the product that you're trading. Okay, this is the kind of homework that you have to do. It's not so easy as you just lay back and just trade all the time. Okay, the risk tolerance level is medium here, compared to scalpers, which is low. That means they take they will have a higher tolerance level. Okay, they also allow for higher tick point movement range. Like I say again, scalpers just now, 8, 10, 12 points, they take profit. 3 points, 4 points, 5 points, they cut loss already, they just get out. Okay, whereas for a medium-term speculator, they will allow much bigger movement or range. Okay, the asset is the same, similar to a scalper. You have to be experienced, obviously. Discipline, very important. They will have a larger risk management ratio, which I will give an example on my next slide. Okay, startup is higher, much higher than a scalper. Okay, you will need, I think, a range of 250 easily to 350,000 to become more of a medium-term speculator. Why? This is because you will need to hold a larger position and for a longer time. Right, now let's try and get some examples in, so that you can have a better idea on how this works. Now, if you have been observing FCPO over in Bursa, Malaysia, you can see that within days, right? Within days, FCPO swings between 60 to 200 points between 2-3 days. Easily, it will swing. Just now, the example I give you from a scalper perspective, they look at it within minutes. So within minutes, it can go 10-20 points easily. That's the time frame that we're looking at. Here, the time frame is 2-3 days at most. This is something that you can see in FCPO, 60 to 200 point swing easily. Okay, and then there is this Number of contracts, like I say again, is very liquid. So if you want to put in 10 to 30 contracts, you can easily get it done without no problem. Okay, same requirement, 6,000 ringgit, that's about it, required by Bursa per contract. So again, any 240 points movement against you, you can wipe out your initial margin easily. Now, when you start being a trader, right, these 3 points is important for you to do homework on. You must try to understand, what is the trading range of a certain product. Okay, when the trading range is 60 to 200 points, and you try to adapt a trading plan that is like 1,000 points, it doesn't work. It just doesn't balance out. So you have to adapt to the kind of volatility of that product. Then you'll have a rough idea. So that's number one that you have to do. You have to look at the trading range. Similar to scalpers, when you are looking at trading range that is between 5 to 10 points, and they want to scalp it looking at trading range that is 60 to 200 points, it doesn't work because it is just not part of the plan. Okay, and then the other thing is that the third point here, you have to look at the maintenance margin, right? So you have to know that, if it goes 25% against you, 50% against you, that means 60 points, do you have the funding required to be able to hold the position? So these 3 points is very important. So I'm going back to it. You have to know the trading range. You have to look at the liquidity. That means once you go in 10, 20 points, easy to 10, 20 contracts, can the market absorb it? You don't want to be trading and putting in 500 contracts when there's no liquidity, there's no buyers or sellers that's able to absorb the big position that you want to put out. Okay, that is not the right way of doing it. Now, cost is slightly higher because you don't trade so much as a medium-term speculator. Just now, remember I told scalpers they go in and out, 5 lots, in, out, 20 within a day, they do 20 times. Straight away, they can do a lot of contracts. The broker will be saying, okay, I can give you a lower rate. Here, they don't trade so many times within a day. All right. Normally, within a week, they take position 5 to 10 times only. All right. That's the norm. Okay. And why is it so less? Because they take a higher price range. When the price don't move within that range, they don't have time to go in and out, or they don't have a chance to go in and out so much. Okay, this will make sense from hopefully some examples that I will give at a later stage. Now, risk reward ratio again, unlike the scalper just now, scalper is 3 to 10. This one, they allow for a bigger range movement. That means anytime that the market goes against a medium-term speculator by 60 points for FCPO, they will get out already, right? And then they will only start thinking about taking profit when they are 200 points up, either when they're buying these 200 points up, or when they're selling, the market has gone 200 points against gone down, then they will look at taking profit. Okay, so this risk reward ratio is actually in tandem with the price range that I told you just now, that you have to look at the price range of that product is important to actually come up with a viable risk reward ratio. Okay, I hope it's not too technical, and then maybe we can get into some examples. Now let's look at some figures. Easily, let's say you want to go in each trade, you participate 20 contracts. So your losses could be, if it hits 60 points against you, 20 contracts times 60 points times 25 ringgit, you could lose 30,000. Okay, on the upside, if it goes your way, you could make 20 times 200 points times 25, which is 100,000 ringgit. Now, put that in terms of success rate, it's similar or about the same as a scalper, looking at the kind of ratio that I've given you here. So basically, around about 1 out of 4, you're already breaking even again. But the key point here is that the initial margin required to be a medium-term trader. Just now in the scalpers example, you need roughly about 30,000. You go in and out already. But for a medium-term speculator, you need a lot more. So in this example I've given you, you'll need about 120,000 just to hold the position of 20 contracts, okay? But then the return on interest is high. So how do you calculate that? Basically, you're putting up a margin. Oh, I'm sorry. In my second last point, initial margin, there's a spelling error there. It's not initial margin. So initial margin required is 120,000. So when you put a trade, 20 contracts, you put out 120,000. If your profit comes through, you make 100,000. In terms of return of investment, it's 83%. This is one trade, and you make 83%. Compared to Scalper, it's only about, if I recall, about 4 or 5% only. Now, there is a difference. When you trade this, let's say within a day or 2 days, you're making a return of investment of 83% within the 2 days. But for a Scalper, every time it goes in is 4%. If it does 10 or 20, and it's a 50% rate, then he's easily making 30% return already on that day. You know what I mean? It just adds up at the end of the day. Different style of trading, but the return could be just as good both ways. Because one bits and pieces, but it then accumulates and becomes just as big. Here you trade less, but the return on investment is just one off. It's a lot better. It's a lot higher. Okay. Now let's do a quick summary. I just put it on a table here, just to refresh you. Recall number of contracts, it's a lot smaller for a Scalper, right? Compared to a medium-term trader. Scalper can trade 1, 2, 3, maybe up to 10 contracts at a go, but nothing more than that. From what I've seen or what I've experienced from some of the traders within our broking arm, very seldom they'll take more than 10 per go. These are Scalpers. Whereas the medium-term traders sometimes take minimal 10 contracts. Sometimes they take 30 up to 50 contracts easily. Okay, turnover is very high for a Scalper. Within a day, they trade easily 20 times, 30 times. But sometimes if you're a disciplined trader, you might just quit while you're ahead. It doesn't mean that you trade more times you trade, the higher chance it is. It's just that opportunity comes, and when you need to take a rest, or when you say I just want to quit while I'm ahead, they just stop and just leave it as it is. Whereas a medium-term trader, their turnover is much lower. Maybe within a week they only trade or take a position 3 to 5 times. Okay, volatility exposure is higher when they take a position. Their exposure is higher for Scalpers and lower for mid-term traders. Okay, return on investment, like I said just now, around about 4% for Scalpers. Small, but because of high turnover, they are compensated that way. Again, small, 4% every time. 10 trades really, they make 40% return. Okay, much higher for medium term, but again, they only do 1 or 2 trades every few days, right? Capital, of course, is much lower from a Scalper's perspective. You only need 30 to 50,000, whereas it's 10 times more for a medium-term trader. Okay, cost in terms of brokerage, because a Scalper trades more, go in and out every time, right? They can demand or actually ask for a lower brokerage fee from the brokers that they trade with. Whereas for medium-term trader, they don't trade so much and so often. It's more difficult for them to demand a lower brokerage cost. The second last point is something that you need to be aware of. You see, a Scalper don't take overnight position. So, and they usually close out. So they go in, few points, they cut loss, or few points above that, they take profit. They go in and out. And by the end of the day, most Scalpers do not hold positions. They will make sure they square off by the end of the day. So they will have a good night's sleep, and then the next day, market opens, they trade again. Okay. Whereas a medium-term trader, where I said just now, they take position and they hold it. They hold it for days and sometimes a week, 2 weeks. So can you imagine if your position is very big? Sometimes, even though you're cool and calm and collective, but I'm sure when you sleep at time, you think, oh my God, what's the position? Some people that I know of, even in the middle of the night, they wake up, they on their TV, they look at, Dow Jones, what is he doing? They look at soybean, what is he doing? And, then if it's going their way, maybe they can sleep better. If it's not going their way, they will have they will start to panic and wake up a lot earlier the next day. Risk ratio is actually up to individual preference. The examples that I give you, 310, some 138, some 1312 for scalper. It's really up to the kind of risk tolerance that each and every one of you might want to do. Okay. Let me do, okay, another summary that I want to bring out. Remember, to do some homework, okay? Whatever that you choose to become, the three important things that you have to remember, right? First, measure out the trading range, because no point for you to put a 310 when, the whole day it's going to be trading at 2-3 points movement only. Then you'll never see your profit. You'll never go 10 points one. You know what I mean? But if you put it too big, let's say 3 to 20, but again, the volatility is not doesn't even reach that at the end of the day. There's no point also. You won't hit your profit levels. Okay, liquidity is important. Don't start. If you look at the product and the buy and sell volume is always about 10, 20 contracts. That means if you put in 3 contracts, 5 contracts, you'll be able to go in and out quite easily. Don't try to be hero, trying to put a 100 contract position when buy and sell is only like 3 lots, 5 lots, you will have a problem getting out. Going in might be easy, but getting out will be a nightmare. Okay. Maintenance margin also always remember, because this has to do with the kind of funds that you have. If the maintenance margin is a little bit too high, that means once it hits a certain loss level, your broker is going to be asking you to top up, then you are going to be, your trading plan will be disrupted. Let's put it this way. Okay. So for that third part, the issue here is trade within your means. Okay. Don't try to trade beyond what you have. All right. You have a good idea as well when I show you the slides of how the performance of some of the traders that I have over the last 12 months. Then you will need to have a think about that on the kind of trader and the risk reward ratio that you want to put up. Okay, that's for one type of trader. The second type is what we call arbitrager. All right, arbitrager is actually a kind of trade strategy based on mispricing. Basically, is based on mispricing. I want to start off with examples. All right, just from a layman's perspective first, of how arbitrage works. So then only I will go into FKLI, then maybe you can piece them together. Okay. Now let's say that you have a friend. Let's say you're from JB. You have a friend, okay, there, and he owns a car. He owns a Proton, okay, and he owns a Proton, and he has a desire to upgrade. He wants to buy a BMW. Okay, so he has this desire because recently he strike lottery. Okay, so he wants to buy a BMW. Okay, he's looking for a 1-year-old BMW, let's say 320, and then he's willing to pay up to 180,000 for this 1-year-old BMW. Just think about it. Okay, and then you're in KL working, and then you have a colleague who also got promoted. Now he drives currently a BMW, also a 320i. Okay, so he is saying that, okay, since I'm promoted, I want to upgrade to a 5 Series. So he wants to sell his BMW for, let's say, 150,000. Do you see the mispricing? Do you see the arbitrage here? This is an opportunity to make what we call risk-free money, buta money. You have a friend in JB who's willing to buy a similar kind of, well, a 1-year-old BMW, similar color and stuff like that for 180,000. He's willing to pay 150,000, and you have a chance to buy from your colleague in KL for 150,000. Correct? So this is an arbitrage opportunity. You buy from your colleague 150,000. You drive it to JB, show it to your your friend in JB, and then he buys it for 180,000. So you make 30,000. That's not clean. Obviously, you know, you have to pump petrol in, and then you know, you might want to buy insurance for that trip. So in case you don't drive to JB and suddenly have an accident, and you know you're stuck with a damaged car or whatever, or you want to be safe, you take a picture of the car that your colleague is driving and then send it to your friend. So to make sure, hey, this one nice or not? You want, then you know I'll bring over to you have a look. Basically, it's all about mispricing here. You have a product that's the same, but you have buyers and sellers who is not in tandem in pricing, and you come in and you try to make the money there. So this is how arbitrage work, basically based on mispricing. Okay. Now, from a layman's perspective, I want to now come to the example that I'm giving here, which is like between the Kuala Lumpur Composite Index, you know, the KLCI that you're seeing every day on TV or newspaper, whatever, that level, right, against the FKLI. There sometimes is my mispricing, and sometimes arbitrages will come in and make money from there. Okay. There's another thing that this particular session is for your information only. For those, I believe most of the participants here are looking at becoming an individual trader. So you could be trading against arbitrages. This is why I want to explain to you how arbitrage work. So most of you who want to become professional traders, you might not be an arbitrager unless you're working for a company. Okay, I'll explain to you later why as well. Okay, but it is important for you to know how arbitrage works, because some of your trades as a scalper or as a speculator might be against an arbitrager. Okay, now going back, the Kuala Lumpur Composite Index. All right, if there's a mispricing and the stocks is too low, you can buy it and then you sell futures and make the difference there. Again, I would understand most of you would know how futures work, and definitely if there's a mispricing towards the end of the contract period, the two between the underlying and the futures contract will converge. The example, there'll be an example that I'll give you, but then this is the fact. Towards the end, there will be convergence between the two, the index and actually the futures price. Okay. Another thing that you have to know, like I say again, there's costs involved. There will be cost of interest, there'll be trading, and there will be slippage. This is a term that you might not understand, but never mind, you can ignore it for now. This cost, the three of them, must be higher than the arbitrage profit. So going back to my example just now about the car. So the thing is that if you're looking at 30,000 and then all the costs, pumping petrol, buying insurance and stuff like that, is less than the 30,000, then it's a trade that you can do. If the profit is only about, let's say, 1,000 ringgit, you might want to think about it. Why do I want to put 1,000 ringgit to drive down to JB? It will cost me like 30 ringgit, 50 ringgit, toll money, everything some more, plus the insurance I have to buy. It might not be less than 1,000. So it will be a loss trade rather than a profitable trade. So when you do an arbitrage, you must be aware that the mispricing, the difference, will have to be more than the total cost that will be involved. That, hope I can give you an example later as well. Now, again, arbitrage is mispricing. So when people arbitrage, they buy one and sell the other, the execution has to be very fast. In this aspect, from the experience that I have, very few individual traders will be able to execute it manually. Most of the time, program trading is required to execute an arbitrage trade. Again, like I said, you know, as an individual, it will be good for you to know who are you trading opposite. It is you as an individual, you might not have a chance to arbitrage so much. Okay. Funds, you need a lot of funds. Again, if you're buying stocks, you need a lot of capital to hold the position to buy all the stocks. You might not need so much for futures because futures is a leverage product, but definitely to hold the stocks, you have to have a lot of capital. Okay. Let's do some very simple example. Let's say we are early August, right? There's a mispricing here. the KL composite index is showing 1600 level, okay? And then the futures for August is actually trading at 1625 at a very high premium, 25-point premium. This is an obvious mispricing, okay? How do you make money as an arbitrager here? Basically, same thing like the example I give you about the car. You buy the lower one and you sell the higher one. So in this case, you buy the 30 component stocks of the composite index, and then you sell the equivalent of FKLI futures. I don't want to go into detail here because this is just a concept that I want you guys to understand, right? If you know about the contract specs of FKLI, you would know that you will definitely converge at the last business day. Okay, so in the last business day of August, let's say the KLCI gone up, it goes up to 1635. So how do you make the money there? Of the 30 stocks that you bought, okay, you will make an equivalent 35 points because from 1600 it's gone to 1635. For the futures that you've sold at 1625, you lost money here because when you sold, you want the futures to come down. Instead, it settles at 1635, so you have a 10-point loss. At the end, after minusing, okay, ignore all the brokerage costs and whatever, you will still be making a gross 25 points profit from that. Okay. And there's only going to be like 2 or 3 outcomes only. I gave you an example just now, in the market KLCI and they're closing up. Let's say, for example, the August, at the end of the last business day of August, the KLCI actually comes down. Okay, you've bought the component stocks at 1600 level, and then you close back the position and buy those shares at 1595. Again, you've lost 5 points. But the futures that you sold at 1625, it came down. You actually make 30 points from there. So gross profit of 25 points. Right? Clear on that? Just now was an example on FKLI. For FCPO, it's similar. I don't want to spend so much time on this particular thing because it's quite technical, FCPO. It actually involves being a Malaysian palm oil board license holder, and then physical delivery means it's very technical. So I'm just gonna quickly skip through this because I just want to show you that FCPO, there's also arbitrage opportunity, all based on the same principle, mispricing. Once there's big mispricing, there are people who will come and take a position. Okay, few points about arbitrages. Let's take it up one by one. Very low risk involved because when you're buying one, you're selling the other. So basically, one side will be profitable, the other side will be losses, but the profitable side will be much higher than the losses side. Okay, risk reward ratio is high. Speed of execution is very crucial. Okay, in the layman's example I give you about the car just now. So like I said, you could make a mistake by execution too slowly, as in like you bought the car already, and then you wait until a week or 2 or few days later, then only you drive down to JB and show the car to your friend in JB when he already bought the car, then you're stuck. So when you do this execution, you must make sure that you do both sides simultaneously and as immediately as possible. For the example I give you, FKLI, when you execute, you must make sure you buy the 30 stocks in Bursa, in the KLCI, immediately, and then sell the futures just at the same time. It must be simultaneously. Cost of trading must be low, but as a professional trader, this is crucial. You must try to keep your costs as low as possible. Okay. Funding requirement is high. The example I gave you definitely is true, because if you have to buy 30 stocks, you buy one stock, one lot of telecom, one lot of Tenaga, Dabi, everything, it could cost you thousands and thousands of ringgit just to hold the stocks position that you've just put in. Same principle, it all works on mispricing. Okay, anything that's mispriced, arbitrage will come in. Once I reiterate again, it is not for individuals like most of the participants here, it's normally performed by hedge funds, fund managers, all right, proprietary positions, program, algo traders, all right. Before I wrap up this arbitrage, I just want to point out about hedger here. I don't mention much about it. Hedger is a bit like an arbitrager, but arbitrager we call it, but sorry, hedger is either a negative arbitrager or a neutral arbitrager. Mainly, that's trading jargon. Hedger is more like an insurance play. A hedger is usually an insurance play. Very simple. Let's say you're a fund manager, working for a very big fund like EPF, PNB, and so on. So if you're holding a very large position, and we're talking about hundreds and hundreds, even billions of shares, okay, and then some negative or rumors comes out, that there'll be big problems for Malaysian economy, or there'll be big political unrest and stuff like that. What do? If you want to be safe, you sell off all the shares that you hold, and then find out that actually it's a rumor and it's not true and things became normal again, then you buy back all those shares. That is going to be very, very expensive to do, because if you trade stocks, you'll realize, unlike trading futures, stock trading is very expensive. So if you sell all your shares, there is a commission to be paid. And if you buy back all those shares just to have the same position as before, it is also very expensive. So when you are worried that your portfolio is going to diminish, what they do is that they sell the futures just to protect. This is what we call insurance play, just to protect against the downside movement of their shares. You get what I mean? So if it's actually a false or only a rumor and normalcy is back, then they just buy back. Yes, they will lose a bit on trading the futures, but again, it's not expensive, because trading futures is very, very low cost compared to trading shares. Okay, that's the bit about hedging. Now I want to talk about the third kind of traders. We've got all sorts in M Investment Bank. There are those who specialize in spread trading. Spread trading are, again, a bit like arbitrage. You take a buy on one side and you take a sell on the other. Mainly, you trade on what we call spreads. There are a few kind of spreads. The first example I'm showing here you on this slide is called an intra-product spread. Don't think about it technically. Don't worry. This example here is between Chicago Mercantile Exchange, the soybean product, against Bursa Malaysia's palm oil product. Now, most of you, or if you do not know this, soya and palm oil is like a complementary product, sort of like moves in tandem. So usually when soya is up, palm is also up, and vice versa. Now, if I can, okay, you can see my cursor here. You see, most of the time, one of these products is up. So there is an opportunity here when it starts to cross over. And you're saying that, the orange line is usually trading above. Okay, so this is become abnormal already. So what you do here is you start trading the spread. Okay, and then when it goes to normalcy again, when orange is back up so big, then you take off your spread trade. Understand? Here, when it's coming down, the orange, when it's supposed to be high, you buy the orange. You buy the orange and you sell the white. You get what I mean? So when you sell the white, and here, when the differences is back to normality, right? You sold here, but it actually has gone up. But it's gone up a little bit only. You can see here, right? But if you bought here, and it's actually gone up so much, you see the difference here. You bought, you want it to go up, it's actually gone up so much already. So like an arbitrage, the amount of profit is here, the amount of loss is here only, and then you make the difference. You see, they trade on the differences here. Like you say, more normally you see again here, the orange is usually on the high side, much higher. It's never the same. Here is a chance. People who specialize in spread trading, they look at it here again. Okay, why the orange is the same as white now? They buy the orange, they sell the white. And then when there becomes a big gap like it normally does, then again, they will unwind their position here. okay? But then sometimes they have to hold this position because it doesn't go back to normalcy until maybe a much later date. So they will hold all the while. Okay, this is basically basically about spread trading, right? People believe that not in normal circumstances there's always a gap, but when it reverses, there's a chance for them to take a position. That just now that example that I gave you is actually intra product. Okay, here there is a time spread as well between near months and far months. So again, in this example, is actually the CPO. Most of the time, you see the white line is trading at a premium from the orange line. You see the green areas, they are huge. Okay, and then when it becomes a point where it's the same, then some of these spread traders will say that, hey, this is abnormal. So what do you want to do? You actually want to buy the white line and sell the orange line. So can you imagine if you've gone in here, you buy white and you sell orange, and then you try to get out here. Okay, when you're selling orange, okay, and then you get out, you're losing so much. But the white line, when you bought and you get out here, you are making so much. Sorry. Okay. I hope you can sort of look at my cursor here, right? When you sell orange, you're losing money. You want it to come down, but actually you got out here. So you sold this level, you bought this level, you are losing so much. But the white, when you bought at this level and you sold at this level, you are making so much. You see, you are still making that gross here. Okay, this is one of the examples of a spread trading. Okay, there's also other spreads like soya could be which is traded in Chicago and also traded in Dalian. There is a chance. You see, most of the time the white line is above, and if there's a chance that it's coming down, met together, what you do is you buy white, you sell orange. You see the difference again. Similar, this is how spread trading works. Some of the things that you need to know about spread trading, I'll put down in points here. So it's a bit like arbitrage. You take opposite position. Okay, one you buy, the other one you sell. Right? Very low risk involved here because they are all moving in tandem. The risk reward or the return on investment is average. Is actually in between being a speculator and arbitrager. All right. Speed of execution is crucial here as well. You make sure that you go in for both at the same time. Buy and sell, both must be executed together. Like all trading, cost of trading must be low for it to work out for you guys. Funding is higher, okay? Because if you're talking about different products and different exchanges, you have to put margins for both sides. Both sides, you have to put margin. Same thing like arbitrage, it works on the basis of mispricing. Again, normally performed by corporates, hedge funds, prop desk people. Okay, that covers mainly the three types of topic one anyway. So I'm going to go through now to topic two. What are the requirements that I think you should consider when becoming a full-time trader? Okay, few key areas. Firstly, attitude. You must have the right attitude. You have to avoid stubborn. There's a spelling error here. There's only one N. You must avoid stubbornness here. Don't be stubborn. Right? If you think that it's not going right, it's gone against your plan, just exit. Don't try to be hero and say that no, this is not right. Okay, have an open mind. Explore all kinds of possibilities when you become a trader. Right? Don't be just trading one particular product. Try to look at as many products as you can, and then make use of technical analysis and see that whether the analysis that you like to use can suit the kind of products that you would like to trade as well. Right? Learn from your failures. That's important. Right? It is believe me, it's costlier if your failures come later. As an advice, I hope that your first few trades actually you lose money. Then you're not going to trade a lot when you first trade. You're going to do one contract, two contracts. So if you learn from there, your losses will be small. Trust me. If you first trade, you start to make money, and then you have this invincibility emotion. You will think that, wow, whatever I touch also will be gold one. Then you're gonna regret it, because as your confidence go bigger and bigger, and you trade bigger and bigger, and your position is bigger. Once you get it wrong, you will have this stubbornness that you can't avoid. It says that I cannot be wrong, and then suddenly, by the time you find out that you are wrong, you already pokai already, no money, bankrupt already. Oh, very, very important. Never shun from asking. Don't worry, it never costs to ask. Just don't be so stubborn and pride, and then you think that you're asking a stupid question. When you're starting off, nothing is stupid. It's more stupid not to ask and lose money. So don't feel shy, just ask anything that you think will help you. What are the other things? Discipline, very important. Okay, when you go in a trade, right, you must have a plan. When I talk about scalpers, they have a momentum, but when they go in also, they will say that they will have an idea. 2 points I cut off, 3 points I cut off, 8 points I take profit, 12 I'll take profit. They have a plan, they have a ratio. You cannot just go and say, "Look, I wake up today, wow, the sun is bright, I think the market is going to go up." You can't. You just have to have a plan when you go in, and then stick to it, right? Accept that you're wrong, accept losses, learn to fight another day. Don't be so stubborn and then keep on letting your losses ride and then right at the end of the day, by the time you realize that, it's going to be too late. Prudent profit taking level. Now, there is a trick to this. If I can give you tips, when I said just now, you have a plan, right? Let's say you want to take profit when it's 20 points, and then you cut loss when it's 5 points against you, right? So what happens here is that if it drop 5 points, you will cut loss, and it goes 20 points. Let's say you're buying, right? When it goes 20 points up, I'll take profit. So there's a tip here. If you have a relatively big position, you got 10 contracts, all right? When the market actually goes up to your level, right, you can not take all your profit if you want, okay? So let's say you got 10 contracts, it's gone to the level, right? You can take 5 contracts profit, leave the other 5. But when you leave the other 5, you remember that when you enter that time, if it goes 5 points below you, you want to cut out already. So at this level, if it goes 5 points below here already, you cut off the rest of the 5, but you will still be making 15 points. Remember, 20 points against 5 points. You get what I mean now? So that could be a kind of strategy that I've seen some of the traders that I know take as well. It doesn't mean that they're going against their policy. They're just saying that, why don't I let my profit ride? So they make, by following this trailing stops that we call it, right? They make less only, but they still let it ride. But if the market has gone up higher, they will compensate for it. You know what I mean? So you can read about this. I mean, I'm sure you can Google and internet this. It's called trailing stops. So trailing stops can work in a taking profit environment. So read up about it. If you don't still don't understand, we can touch. Okay. Other things what you need, be analytical. Okay. You don't have to be a rocket scientist, but at least be diligent. You have to have some idea. Why is the price acting a certain way? You cannot just say, you cannot say the whole market is going up. You just go, wow, full terror, whatever. Just try to find out, hey, what's happening, man? Why is the market going up? Suddenly everybody thinks that Malaysia is a great country to be investing in, or what? Having good figures, or ringgit is weak and people are investing in, and then stuff like that. Try to find out or have a certain idea, what is happening. And then also ask yourself, when you go into a trade, everything when it's working well, fine. I'm here to tell you, don't worry so much of the things that goes right. But what's important that what if it doesn't go as you plan? What if, you must be prepared, there's so many things that can happen. So always ask yourself, if this happened, I know what to do. All right. You can't be just freeze and panic and just like, hey, I close my computer, I don't want to see, let the position right. You can't do that. You have to have a what if case scenario. Okay. The first few slides that I was telling you about, it's about, the opposite position. So remember, it's a zero-sum game. When you're doing a trade, you hope to be making money. So you might ask yourself, why is the guy opposite me taking my opposite position? But they could be arbitragers, they could be hedgers, or they could be spread traders that's against you. So, or they could be speculators as well against you because they have different information. So understanding your opposite position can be a good thing as well. Trying to understand that you can't be smarter than everybody all the time. So try to understand what does the fellow know that I don't, or you could think that, oh, I think I know what he's trying to do, but he's overreacting, or some other reasons like that. Focus, very, very important, especially if you are a scalper. Okay, avoid distraction. All right, don't put on a position. Okay, the scalpers in our office just look at the screen non-stop. Okay, they will, if they feel like they have to go for coffee break or have a pee, whatever, they close off their position one. At worst case, they will put stop position. They would just focus and avoid all the noises, and everything around it. They are just so focused. They learn to filter out conflicting comments. So when you're buying, you're long, any information that's negative, that means the market might be coming down. They try to understand it, and then they will take it as whether it's real news or maybe it's overreaction or fake news, and they will trade using those, but they will filter those news comments. Again, this is information. You must be aware, all right, what is happening around nationally or globally, okay, and schedule their works. Like I say again, some scalpers, they like to trade market on opening. That means, if you're trading FKLI between 8:45 to 9:30, 10 o'clock, they are just looking at the screen all the time. They don't necessarily trade the whole day. They just pick a certain time and they trade it, especially on the volatility and the range that they are comfortable with. And then they trade, they put in 5 trades, 10 trades within that 2 hours, 3 hours. Some I know, they just trade on market and opening. Okay, believe me, they just trade on market opening. If they lose, they just cut their losses. They are okay with it. If they make after a certain amount, they just quit while they are ahead, and then they just go off doing other business, or play golf, or whatever. They don't trade the whole day, because sometimes staying in front for 8 hours of a screen, it can be very, very tiring. So they pick their moments. All right. Be mentally prepared. Okay. Avoid stress lah. It's no point, making money, but then it's too stressful that your health is going to be affected. Enjoy trading. It's a lot fun than having to worry all the time, right? This is very important. Always make sure that you have enough disposable income. Okay, make sure that you have sufficient funds to support your trading plan. Most importantly, don't go like along or go and borrow money to invest or to trade. Okay, trade what you have that's spare. Right? Don't trade. Don't be forced on a margin squeeze. Right? This is the biggest mistake some of the traders do. They will soon find out that oh, I got squeezed out, and then the market go back to their original plan that they knew happened. But because they didn't have enough money, they were forced to close out their position. Okay, you must be aware of what kind of opportunity of investment is around you. Okay, like I said just now, whether you are a scalper, you need 30,000, or you are a term trader, you need about 100, 200,000 or so forth. You have to be aware that if I don't invest this 30,000 or 100,000 as a trader here, what can I do? You know, you must remember the funds are always limited. There's no, free flowing tap. You must choose the kind of investment that's going to bring you the best return, and obviously the less stress. Okay, you have to make sure that ask yourself this question. Okay, what if I got the money but I don't invest? What's the best that you get? FD rate 3%, 3.5%. Then do you want to do futures trading and then make 4%, 5%? Of course not. Why do you take all this risk and then only make 1, 2% more than FD rate? When FD rate basically you don't take any risk at all. Very, very low anyway. Okay. Always think of, don't always just trade and think that this is going to be the only source of income. There's always opportunity, and then you can diverse and spread your risk a little bit more. Of course, well-informed is important. Make sure that real information is important. But then sometimes fake news that affects the market can help you trade as well, because it is an overreaction that you're looking at. If let's say some news you're not sure whether it's right or wrong, but the market starts plunging because of it, then you might think that, hey, this one cannot be true and the market is overreacted. What you can do, there's an opportunity for you as well. So not only knowing the real news is important. Sometimes the news, even if it's fake, that is affecting the market, can be important, can be an opportunity for you to trade as well. All right. Always be knowledgeable and hunt for any market moving news again. Right. Now let's go to the third and final topic of the day: the path, the journey that all of you should be looking at. Obviously, I would suggest that if you're really a novice, just do some paper trade. Okay, not necessarily open an account, or if you can open an account, don't trade first. Just open an account so that you can see the movement, the live prices of those products, and then when you're ready, in small bits pieces, trade as a normal client, and then see whether this is your cup of tea or not. You don't want to be quitting your job making sure you got all the funds prepared and everything, and then find out that after a week or 2 weeks that you are not cut out to be a trader. Then what's the point? If you feel that trading as a client, you're comfortable and you're making decent money, then you can escalate and become a local. Local is actually a member of Bursa Malaysia, such a way that you get special perks. So as a local, you get very low cost trading, and then as a local, Bursa Malaysia recognizes scratch trade. Remember I mentioned earlier on this session, scratch trade is a trade of a product of the same month and within the day, the same price. That means you buy and sell the same product at the same price, it becomes nullified. There's no cost, there's no brokerage cost, there's no exchange fee, nothing. So to give you a statistics, all right, some of the, especially scalpers, when they trade in a day, at least 30 to 50% of their trades are scratch trades. That means, when they buy, they feel the market is going to go up, and then suddenly they feel that the momentum is not there. The market cannot go up already. Then it starts to come down, they straight away sell off. So when they bought, the market cannot go up, and then it starts to come down, they sell off. And when they sell off at the same price, they got no cost. No brokerage cost, no exchange fee, no clearing fee. That's the benefit or the perks of being a local, right, in Bursa Malaysia. Okay. And then if you want to escalate from being a local after that, you want to be a prop trader, there are certain things that you have to look at. So let's go back to the first one first. Start off being a normal client. Do a trial period, at least 2 months. Sorry, excuse me. Do it for at least 2 months. Try paper trade for a couple of days and maybe trade small as a normal client. Then look at the opportunities, you know. It will be less pressure as well if you have other form of income coming in. So like I said, don't quit your job, you know, and then start preparing funds to be a trader, at least until you become a normal client first. Then find out that, is this really what you want to do? Maybe, you know, you don't want to commit everything. You want to put all your eggs in one basket, okay? And then along this way, you can look at whether you want to be just a part-time, maybe it suits you, or you might eventually think that, hey, this is really what I love to do. And anyway, I don't like my current job anyway. So then you can make a decision then. Okay. Then as you're going into this phase, you can see what kind of products that you like. Just now, I give you examples of FKLI and FCPO. FKLI is a slower pace, not so volatile. So you might be somebody who cannot take all this fast pace. Your heart cannot take it. So stick to FKLI. You know, it'll be easier for you. If you want excitement, you can look at FCPO. That is a very fast market, in and out easily, 30 to 60 points within a day. But then again, your heart or your health might not be able to take it. Then if you want to escalate, next level is become a local, right, with Bursa Malaysia. Okay. Choose a broker. Of course, cost is vital, but then again, when you start off, don't be trading a lot just to try to get your brokerage cost lower. Just trade to something that you are comfortable with. Okay, so cost is vital, but then it's not the ultimate thing. Try to get a system capability, like I mentioned just now. Connectivity, all this is important, right? Make sure that you know you have a stable system, reliable, and then user friendly as well. If a broker can give you good research or provide, you know, charting tools or whatever tools that you need or you're comfortable with, that'll be good. Hopefully you'll get good support services from the broker in terms of back office, because sometimes, like I said, when the market is very fast and then each broker has a certain maintenance margin, you don't want a broker that, you know, when you hit maintenance margin, you don't pay and straight away they chop you off. You have to understand the broker has no choice. But the thing is that you have already paid, but their back office system is so slow that even though you've paid, they haven't seen it yet, or they haven't seen the funds coming yet. To them, you haven't paid because it's on the way online from your bank to their bank. It is still to them, it hasn't reached. So these are quite annoying sometimes if their back office system is not so efficient. So some of the things that you have to be aware of. Okay. As far as risk management is concerned, no brokers will take risks. So make sure that when you're paying up your margins and everything, that you do the payment lah. Don't be blacklisted as a bad paymaster. Then you know the broker, if they don't trust you, it's gonna be a kind of bad relationship. So try to be a good paymaster. Okay. I promised you guys that, you know, at the end of the session, I would have some sort of table for you to look at. Just give you guys a minute to look at this. Now, ADG, I can't put their names up lah, obviously. I got A to H. These are all traders in within our broking arm. Okay, these are locals, you know, and ADG are scalpers. All right. When I put those figures in bracket, that means they lost money for the month. Those without brackets are positive. The ones I highlighted yellow are scalpers. Actually, H is also a scalper, but she's quite new now. She trades very, very small, but she's just she's not full time as well, so she's not really dedicated. And then she's got not enough funds, so she's always being squeezed in terms of margin. You can see she's not doing very well here. But what I'm trying to show you here is that, you know, I don't want you to be swayed by this, but generally the yellow ones are the big profitable ones, and they are scalpers. And I tell you, being scalper, they don't worry much. They have very good night's sleep one because they close their positions. intraday. They just close their positions. On average, they make about 15 to 20K. But it might not be a lot, but you must understand these scalpers that I mentioned here, this is like part-time to them. Like I say again, they don't trade the whole day. They've got other businesses like, they have restaurants on the side, they have a couple of houses and property and factories, they're getting rent and stuff like that. One of them is even have durian orchard, he goes there and look at his durians sometimes. So he doesn't trade all the time. He only trade like a couple of hours, make some punts, going out, his trigger is just to make like 3,000-4,000 a day. That's it. Sometimes he makes, sometimes he loses, but then he just trades within that period and then they get out. So, trading might not be rosy all the time. You see, some people make 200 over 100, 200,000, but then there are those who lost as well. But again, I'm telling you, each and every one of these traders, it is not their full-time income activity. All right, they have other things, and it makes their trading a lot more, how do I call it, relaxed in a way. Okay, just some numbers for you to observe. Okay, for you to understand. Now, last one, of course, is being a proprietary trader. Okay, when you are looking to be a proprietary trader, that means be employed and with a corporate. Few things that you have to know. Fund size is important. If the fund size for you to trade is too small, then your opportunity or limits is going to be contained. But if it's too large, also it's difficult to have a good return. Okay, let me give you an example. Just now, let's say you trade as a medium-term trader, you put up 250,000 on a trade, you can make 100,000, right? But that's easy. You can go in now. But let's say instead of 250,000, you're given 250 million. You want to trade 250 million, like I said, the liquidity is not there. You got not enough. You're too big for the market. All right. So when it comes to that, then if you got a very big size of funds, it depends on the scope of the product that you're allowed to trade. And then if they give you the scope, is it the product that you are familiar with? Those are the things that you have to contemplate being a proprietary trader. Okay, then what flexibility do they have for you? Are you just going to be pure arbitrage trader or spread trader? But those kind of traders, they don't have opportunity all the time on, or you're allowed to do positional positions too. Okay, important is mentorship here. Most of the big proprietary firms, they have experienced traders. What you need is that when you go there and join them, you make sure that you get the experienced traders to show you the rope, because at the end of the day, you want to avoid making same or similar mistakes like they do, right? So be a likable person now. Don't go in there and then you're so stuck up, nobody wants to talk to you, and then you won't learn anything, and everybody's just waiting for you to fall. Right, that's quick summarize of the key takeaways. Three categories of traders that we look with, that I've covered: being a speculator, arbitrager, or hedger, and spread traders. And then the kind of prerequisites that's needed to become a full-time trader: attitude, discipline, analytical focus. Most important to me is adequate disposable income. Those are the features that you will have to need to become a full-time trader. Last bit that I covered is, the path of being of a career path of a trader. Start as a client, be a local, and then maybe you want to venture in to become a prop trader. Most importantly, try not to be led. Take control of the path. It's your choice. Just enjoy trading, enjoy life. Okay, I hope it's as simple as I can make it.